The Nifty holding at that 18,150 mark.
Things are quiet, right, on the markets. A bit of a wait-and-watch approach. Markets actually slipped from the top of the trading session.
Almost sort of stuck to that near 1:1 advances to declines ratio. So that's broader markets for you. Finely balanced, evenly balanced.
Evenly balanced indeed. In fact, we just bided our time ahead of the big important outcome of the FOMC. Hello and welcome. You're watching us here on Markets Today. I'm Mangalam Malu. This is a show where we track all the 6 hours of day's trading action in 5 headlines. Let's talk about those headlines indeed. Stock markets across the world were actually trading with caution ahead of the US Fed decision tonight. The Wall Street snapped its 4-day gaining streak. Sensex fell about 200 points. Nifty managed to hold on to that 18,000 mark, in fact, much above that 18,050 mark as well. There's optimism around Sun Pharma's growth outlook for specialty drugs and generics. Even Tech Mahindra finds favor with an in-line performance and attractive valuations. Chola Investment climbs on strong business momentum, while record high margins drive up Karnataka Bank and sharply lower margins hurt LIC Housing Finance. Max Healthcare, on the other hand, sees a good second quarter with higher occupancies and strong hospital revenue growth. Nykaa falls despite a decent second quarter. India is primed for high growth over 10 years, and it can become the office and the factory of the world, says Morgan Stanley's Rhythm Desai. Expects financials, consumer discretionary services and IT services as well as industrials to drive growth in this decade. That's a CNBC-TV18 exclusive. Let's tell you what we have lined up for you on the show today. It's a packed show. In Market Opinion, we have Mihir Vora, who's the Director CIO of Max Life Insurance and Big Corporate Voices. We have Dilip Sanghvi, MD of Sun Pharma, Y. Vishwanathan Gowda, MD and CEO of LIC Housing Finance, a stock that was lower in today's trading session. Let's talk about the stock markets then. Across the world, they were trading with caution ahead of the US Fed decision later tonight. The Wall Street snapped its 4-day gaining streak. Sensex fell by over 200 points. The Nifty did manage to hold on to that 18,000 mark, despite falling by almost 60-odd points. The Nifty Bank, as well as the mid-caps, also saw some bit of profit-taking, understandably ahead of the big Fed outcome. Let's see where we go from here, because then we will watch out for the weekly options expiry tomorrow as well. How did the market fare today? We have Prashant with more details. Prashant.
Well, the market did come off a little bit. It was wait and watch from the morning, and bulk of the session was spent that way. But a little bit of slip happening towards close. It's a big event that we are going into, which is the Fed decision, and the market responded appropriately. Broader markets did better. They corrected less, fell less than what the Nifty did today. Pretty similar in terms of sectoral composition like yesterday. Metals and pharma gaining for the second day in a row. PSU banks pulling back. They've had a good run last fortnight. Consumers and real estate is 2 areas which saw some profit booking as well. Bharti, Apollo Hospitals, Maruti, these are stocks which sort of suffered some cuts. Gains coming through in Hindalco, Sun Pharma, and perhaps ITC as well. Broader markets, advances to decline ratio was about 1:1, so very finely, evenly balanced. Gains coming through in lots of defense names. Once again, Mazgaon Dock. There was Kochi Shipyard, Garden Reach Shipbuilders. Karnataka Bank started strong, ending pretty much at circuit. Sharda Cropchem, Gujarat Fluorochem, some of the others. Broader losses coming through in LIC Housing, which slipped quite a bit in reaction to numbers. Chambal reacting to numbers on the downside, and Kajaria selling off a little bit as well. As I said, the big decision is the Fed. A hike is priced in. The big question, there are 2 questions. One, will the Fed indicate a downshift in the future pace of rate hikes, which is what they will do in December? Will they leave the room open for 50? And if they do, how much of that is in the price is the big question. The S&P 500 is already up about 10% in the last 12 or 13 sessions. We'll react to all of this tomorrow morning. And of course, there is also the RBI MPC, which will be closely watched. Big events. And of course, the market coming back tomorrow. Back to you.
All right, we take that point, Prashant. Thanks a lot for that. Let's also get you some expert opinion now. Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, continues to be bullish on the Indian domestic economy. Giving his take on the realty space, he did say that there's traction in the real estate space and it has good underlying demand. So perhaps a good bet for investment as well. Listen in.
I think we continue with the domestic theme. We have been bullish on the domestic economy for quite some time. More urban than rural. I think consumption is stronger on the urban pockets. Rural pockets are still to catch up. So a bit of a K-shaped recovery, but we have seen that the markets do represent a fair chunk of the, the large corporates and the organized sector. So to that extent, maybe the rural weakness is still not reflected in the market, except in some pockets of FMCG, etc. So stick with the, the domestic theme that includes financials, industrials, cap goods, EPC, and of course the discretionary segments like not only the services like hotels, etc., but even automobiles and thereabouts. Real estate is one segment where we are seeing some traction, and if hopefully we are nearer to the end of the tightening cycle by the Federal Reserve and the RBI, and if interest rates don't move up much sharply from these levels, then even real estate seems to have a good underlying base demand that should drive the domestic economy.
All right, and ahead of the US Federal Reserve's rate hike decision later tonight, that will have a bigger impact on our markets as against the strength of the domestic economy, which has kept us afloat. We got some comments coming in from Ken Peng, who's the Asia Pacific investment strategist at Citi Private Bank. He said that he didn't see a reason for the Fed to shift its stance. However, he also believes that there'll be no space for the Fed to give a dovish signal. And were that to happen, perhaps we might see some sell-off.
I think there's really no real reason for the Fed to turn soft today because, employment is still rising, some 200 to 300,000 a month. Inflation is tapering off a little bit, but we're still at 8%. And so, the inflation bit is still going to be the higher priority among the Fed's two mandates. So I think, if the Fed's talk, right, the press conference, the statement is very similar to September's, then that will be considered as hawkish because the 75 basis point is already in the price. So we're basically comparing the Fed statements tonight versus September. The market function is still continuing; it's just becoming tighter. So I think the Fed, that's basically what the Fed is trying to achieve, right? Tighter financial conditions. So we'll have to see whether in his press conference, Powell will talk about how what is a excessive amount of market instability. So that will be something that the market is very concerned about. In terms of jobs and inflation, I don't think there's going to be really that much space for the Fed to give us a dovish signal. So if we don't get anything on the dovish side, I think you'll probably see some of the recent rally coming off.
All right, we take that point, Ken. With that, we move on to the second headline of the day. Sun Pharma was the one which ended about 1.5% higher in today's trading session, which was an outperformance given the weakness that we saw in the overall equity sentiment. And this after an inline set in the second quarter. Brokerages were also weighed in on what to make of the company's earnings. Ekta Batra joins in with the highlights out there. Ekta?
Thanks for that. Well, yes, the momentum for Sun Pharma continues. In fact, it is at a fresh 52-week high, reacting to the commentary from the management, considering that the conference call took place after market hours yesterday. Remember, numbers came out during market hours, so the company did see, or the stock did see, that sort of momentum post the Q2 numbers being released during markets yesterday. Now, in terms of a couple of key takeaways, the global specialty sales were up 27% year-on-year. It was really the key driver in terms of numbers. They did $200 million in terms of total sales. In fact, the company has said that they are exploring in-licensing opportunities, M&A, when it comes to their specialty pipeline. Moving to the other segment in the US, which is basically the generic segment, they did say that price erosion in the US does remain. So that does remain a concern for most companies which have a portfolio in the US. They are on track to launch the generic version of Revlimid generic, which is basically the cancer drug in the US market. But yes, they are not in the second wave of launches as it was expected. The Halol plant has an official action indicated status from the US FDA currently, and that continues. The company is implementing remediation when it comes there. R&D expenditure is expected to scale up for Sun Pharma going forward. But as of now, overall, despite the specialty sales doing so well, the company is sticking to its guidance, which it had given earlier, which is higher single-digit, lower double-digit growth, which is intact for FY23. Brokerages, extremely positive, most of them. So, for example, the likes of Bernstein, Morgan Stanley, Nomura, Citi, all of them have maintained their ratings. Many of them have increased their target prices on the stock. One of the outliers is Goldman Sachs, which has a sell and a target price of 830. On the positive side, brokerages have said it is well diversified in terms of a business which is helping Sun to manage its business volatility. They are positive in terms of the US markets as well as the margins driving growth. Goldman Sachs is a bit skittish bullish on Sun Pharma simply because of factors such as intensifying industry-wide US price erosion.
Consolidated sales for the quarter were at rupees 108,092 million, up 13.1% year-on-year. Most of our businesses witnessed good growth, led by global specialty business, India, and emerging markets. For Q2, our global specialty revenues were up 27.5% year-on-year to about $201 million. Ilumya, Cequa, and Winlevi were the growth drivers for the quarter.
That's about Sun Pharma. Let's talk about Tech Mahindra now. That also came out with an inline set of second quarter numbers. We spoke with the company's MD and CEO, CP Gurnani, as well as the CFO, Rohit Anand, who said that the firm would actually continue to work towards a margin benchmark of almost 14% by the fourth quarter of this financial year. They added that Tech Mahindra also increased its profitability despite increase in salaries. Take a look, because the street liked those numbers and valuations supported it as well.
I think it is just a way overall Tech Mahindra's product mix is and the geography mix is. From a geography mix, you know that we do about 49% from US, whereas most of the peers are at about 70%. The second part is from a product mix point of view, there are certain sectors which are right now relatively slower. So I would not read too much in this particular 2.9% versus 3 point some other percentage, because you have to look at the overall operations have been run very, very beautifully. And when I look at considering that we did a salary increase, we are able to increase in profitability, we are able to become better by in DSO days. Our free cash flow is one of the best in the recent quarters. Overall, my customer wins, my large deal wins continue to be 700 million plus. I think it has been a good quarter.
All right, so that was the management of Tech Mahindra. The third headline today, financials, they were in focus today after Chola Investment gained close to 5% on strong business momentum, while record high margins kept Karnataka Bank rally a whopping 20%. It locked at upper circuit. And then we had LIC Housing Finance, which is down almost 8.5% on account of weakness in the margins. Abhishek Kothari joins in with the details of all of these numbers. Abhishek, actually, let's start with LIC, which fell in today's trading session.
Well, the big missing point in LIC's result was the net interest margin, coming in at 1.8% versus an estimate by Kotak Securities of about 2.5%. So the net interest income in itself has declined by almost 28% on a sequential basis. Just to put the number in perspective, net interest margin was at 1.8% when compared to 2.54% in the previous quarter and about 2% in the same quarter last year. Interest income has declined by 3.8% sequentially. This is despite the fact that disbursements grew by 10.5% on a sequential basis, and there was an AUM growth of about 2.6% on a sequential basis. So the PNL, both in terms of NI and PAT, has been below our poll. PAT has come in at about 305 crore. We were working with a number of more than 830 crores. Morgan Stanley has written on LIC Housing Finance, wherein they have an underweight rating and a target price of 375 per share. They say that, the PAT is 70% below their own estimate, driven by the fact that NIM miss was about 34% from their own number. So provisions were 72% higher than Morgan Stanley's estimate, and loan growth was in line with their estimate, given the fact that home loans grew by 15% on a YOY basis. Back to you.
As far as the NIMs are concerned, we are very confident that in the quarters to come, there will be definitely an improvement beyond what we have planned also. And we are very sure that the credit cost will be around 45 to 50 basis points analyzed. That's what we are looking at. Then going forward, both in the developer book and also as well as the individual loan book, we will have very good improvement in our NPAs. Loan book growth is concerned now, we are very optimistic that the growth is around 15%. Then in the coming 2 quarters also, the demand is robust. And we are very sure and confident that we'll be showing a growth of minimum 15% for the whole year.
All right, Abhishek, stay with us. You're still with us on, you spoke about LIC Housing Finance. Let's talk about Karnataka Bank, because that one, a big, massive rally, 20% rally there.
Well, for Karnataka Bank, the P&L momentum was actually very strong, and the stress in the balance sheet has also reduced. So to begin with, the interest income is up 8.7% sequentially. This is despite the fact that loan growth has been just 2.6% quarter on quarter. So the yields have surprised positively. The net interest income is up 16.75% quarter on quarter, given the fact that, deposit momentum was just around 1.5%. So not much of an impact in terms of interest expenses over there. The net interest margin is at 5-year high, or about 20-quarter high of about 3.56%. The PAT was at 412 crore, which compares to about 126 crore in the same quarter last year and about 114 crore in the previous quarter. So the ROA, or return on asset, have jumped to 1.7%. This compares to about 0.57% in the same quarter last year and around 0.5% in the previous quarter. The stress in the balance sheet has reduced. Gross NPA ratio is down by 65-70 basis point on a sequential basis, coming in at 3.36%, and the restructured portfolio, that's also seen a decline in its share by almost 115 to 120 basis point, now at about 6.22% when compared to 7.37% in the previous quarter. So the street has given a thumbs up to this results. Back to you.
Thumbs up indeed. We had Arul Selvan D, President and CFO of Chola Investment Finance. He said that he expects to see about 20 to 22% sort of growth in assets under management, and expects the cost of funds to rise by a little over 50 basis points. Let's hear him out as well.
We will look at around 20 to 22% AUM growth as we move forward for the full year. And if things pan out better, it can even be better than that. With regard to the NIMs, I have spoken earlier also. For the full year, we expect the cost of funds to increase by around 50 to 60 basis points, going by the trend. And as of YTD level, the cost of funds is still lower than compared to last year. But yes, as a quarter on quarter, that is Q1 versus Q2, there has been a drop because of the cost of funds increase. This is expected, and this is what we have guided, as you rightly pointed out. Way forward is looking at the coming festival seasons and a reasonably good harvest, for a predominant part of the country, especially in the context that we are spread all over the country almost equally. So while there could always be some regions or geographies where there can be impact, we will see some amount of reasonable growth in the rest of the locations.
With that, we'll slip into a short break. On the other side, we'll come back with all the other headlines that we tracked today. Welcome back. You're watching us here on Markets Today. We've been talking about all the things that moved around in the market, and let's talk about Max Healthcare. That too was in focus today after it reported a good quarter with higher occupancies and strong hospital revenue growth. Abhay Soy, the chairman and managing director of the company, said that the second half of this year is typically better than the first half, and he added that the international patient levels, they were also back to over 110% of pre-COVID levels, and that would be a big growth driver for them going forward.
Well, typically a second half of the year is usually better than the first half of the year, marginally better than the first half of the year. So what you're going to see is, of course, as far as occupancies are concerned, it's you're not going to have a 78% kind of occupancy when you come off the season in the first quarter. In quarter three, but you will have higher RPOBs compensating for it because you've got, a better surgical mix, more surgical patients, which typically tend to pay you a higher RPOB. I think this, coupled with the fact that we are also seeing extremely high clip of recovery as far as our international business is concerned, we are already back to more than 110% of pre-COVID levels.
Nykaa was down by over 2% in trade today. It reported a decent set of second quarter numbers. The stock moved yesterday. In fact, it gained about 20% in the previous trading session as well. The revenues for the company were up 7% sequentially. The EBITDA was up 33% quarter on quarter as well. We spoke with the management and they said that the fashion segment has actually seen a 43% year-on-year growth this year. And in this quarter, 66% of the fashion's GMV is actually coming in from repeat buyers. Let's hear them out.
We're quite pleased with the fashion performance for Q2. Fashion has grown 43% year on year. It does contribute about 26% of the consolidated company's turnover. I think we're furthermore feeling good about the business in the sense that it is continuing to be contribution margin positive with a clear line in sight in terms of profitability. And then lots of other core metrics are looking good, whether it's a much higher average order value, whether it's the expansion of share of our private labels. So overall, feeling that a lot of metrics are headed in the right direction from the fashion business.
Right, and the fifth headline today, the big newsmaker this evening. India is set to become the world's third largest economy and the stock market by 2031. Not too far from here, rather, according to a recent report by Morgan Stanley. Speaking exclusively to CNBC-TV18, Ridham Desai, the managing director, said that India is primed for high growth over 10 years and it can actually become the office and the factory of the world. He expects financials, consumer discretionary, IT services, as well as industrials to drive the growth in this decade, which he believes will belong to India.
All the labor that we put in terms of policy and other things are now bearing, I think, fruit. There are also a few things happening globally that are helping us. So it seems like a sweet spot for India. In fact, as we highlight in the report, stunningly, India could account for 20% of the growth that the world will generate over the next 10 years. So it's a very, very big shift. India has grown quite well over the past few years, but its share in the global economy is changing in a very dramatic fashion. Now, I'm sensing that companies in India are getting more optimistic. They are starting to run into some capacity constraints. And therefore, there should be a pretty good capex cycle in the next 2-3 years. And that will be great for earnings. So that's something that we'll watch out for as well. But I think India is set to now become a meaningful part of the global supply chain. And a lot of companies will reveal this to you, that they're receiving orders. Hitherto, they didn't have access to those orders because Chinese companies used to take those orders. And they are now all set to increase capacity to service these export orders. On top of this, multinational companies are looking at India as a very attractive destination. This year, India has outperformed emerging markets by 34 percentage points. It's not happened ever before. Emerging markets around the world are really broken. And India is therefore looking so good on a relative basis. But on an absolute basis, the market has not really gone anywhere. So it's been a typical consolidation, I would say very benign consolidation. It could have been a far more volatile consolidation, but it's been a benign one. So I think we're prepping it up. I think 2023 looks like it will be a much better year for absolute returns.
With that, we wrap up on this edition of Markets Today. Thank you so much for watching. Stay tuned to CNBC TV 18 News and updates continue.